Look, I need to show you something that's happening right now in the silver market that most people are completely missing. And when I say most people, I mean the vast majority of investors who are about to watch one of the biggest wealth transfers in modern history happen right in front of their eyes without understanding what they're seeing. Right now, as I'm recording this, silver is trading at prices that frankly shouldn't exist, given what's happening behind the scenes. And I'm not talking about some conspiracy theory or wild speculation. I'm talking about cold, hard data that tells a story so compelling, so undeniable, that when you see it laid out, you're going to wonder why this isn't front-page news everywhere. Let me start with something that happened 3 weeks ago that barely made a ripple in the mainstream financial media. The Shanghai Futures Exchange reported a drawdown of physical silver inventories that was the largest single-week decline in their history. We're talking about 847 tons of physical silver leaving their vaults in just 5 trading days. Now, you might think, okay, that's interesting, but what does it really mean? Here's what it means. That silver didn't just disappear, it went somewhere. And when you start tracking where it went, you begin to see a pattern that's been building for the last 18 months. Industrial users in China, Japan, and South Korea have been stockpiling physical silver at rates we haven't seen since the lead-up to the solar panel boom of 2009. But this time, it's different. This time, they're not just buying for current production needs. They're buying because they know something that the average investor doesn't. The global supply deficit in silver hit 184 million ounces last year. Let me put that in perspective for you. That's the equivalent of an entire year's worth of mining production from Mexico, the world's largest silver producer, just vanishing from the market. Gone. And here's the kicker. This deficit isn't shrinking, it's accelerating. The Silver Institute's latest projections show we're on track for a 215 million ounce deficit this year. That's billion with a B in dollar terms at current prices. Now, you might be thinking, well, if there's such a massive shortage, why isn't the price exploding right now? And that's exactly the question you should be asking, because the answer to that question is what's going to make early movers in this market absolutely wealthy over the next 12 to 18 months. The silver market is unique in the commodities world because it's one of the last markets where paper contracts still dramatically outnumber physical metal. On the COMEX, the ratio of paper silver to physical silver available for delivery has been running at about 250 to 1. Think about that. For every ounce of actual silver sitting in a vault, there are 250 paper claims on that same ounce. It's like a game of musical chairs, where there are 250 people and only one chair. And the music is about to stop. I want to tell you about something that happened in March of 2008 that most people have forgotten about. There was a small investment firm in Connecticut that decided they wanted to take physical delivery of their silver futures contracts. Nothing unusual about that, right? It's perfectly legal. You buy a futures contract, you have the right to take delivery of the physical metal. Except when they made the request for 1,500 contracts, which is about 7.5 million ounces, the COMEX couldn't deliver it. They literally didn't have the silver. The firm had to settle for cash instead, and within 6 weeks, the silver price had jumped 28% as word spread through the trading community about what had happened. That was 2008. The situation today is exponentially more precarious. The amount of physical silver in COMEX warehouses right now is at a 15-year low. We're talking about roughly 285 million ounces total, and of that, only about 72 million ounces is actually registered for delivery. The rest is just sitting there, owned by various entities, not available for delivery against futures contracts. Meanwhile, the open interest in silver futures, the total number of contracts outstanding, represents about 890 million ounces. Do the math. There are claims on roughly 12 times more silver than is actually available for delivery. And every single day, more industrial users, more investors, more institutions are waking up to this reality and deciding they want the physical metal, not the paper promise. Let me tell you what happened to a fund manager I know in Singapore. Smart guy, been in the precious metals market for 20 years. Last October, he decided to take delivery of 50,000 ounces of silver from his allocated account at a major bullion bank. Should have been simple, right? His account statement showed he owned the silver. It was allocated, meaning specific bars with serial numbers were supposed to be set aside for him. He submitted his delivery request, and you know what happened? Nothing. For 3 weeks, nothing. Finally, he got a call from the bank offering him a premium, an actual premium above spot price, to keep his silver in their vault and not take delivery. When he insisted, it took them another 5 weeks to deliver his metal. 5 weeks for metal that was supposedly sitting in a vault with his name on it. That's not an isolated incident. That's becoming the norm. And it's telling you something critical about the real state of the physical silver market. The metal isn't where the paper says it is. The inventories aren't what the official numbers claim. And the gap between paper price and physical availability is widening every single day. Now, here's where this gets really interesting from an investment standpoint. Silver has always had this dual nature. It's both a monetary metal and an industrial metal. Gold is primarily monetary. Copper is primarily industrial. But silver sits in this unique position where it's absolutely critical for industrial applications, and it's also been money for 5,000 years. That dual nature is about to create a perfect storm. On the industrial side, the demand is exploding. Solar panels use silver. Every single panel requires about 20 grams of silver, and global solar installation is projected to double over the next 3 years. Electric vehicles use silver. A typical EV uses about twice as much silver as a conventional car. 5G infrastructure uses silver. The build-out of 5G networks globally is going to require hundreds of millions of ounces of silver over the next decade. Medical applications use silver. Electronics use silver. The list goes on and on. But here's what most analysts miss. Industrial users can't substitute away from silver easily. It's not like they can just switch to copper or aluminum if silver gets expensive. Silver has unique properties. It's the most conductive metal on Earth. It's the most reflective. It has antibacterial properties. For many applications, there is no substitute. Which means industrial users will pay whatever they have to pay to get the silver they need to keep their production lines running. And on the monetary side, something is shifting in the global financial system that's going to drive unprecedented demand for physical precious metals. Central banks around the world are diversifying away from dollar-denominated assets. We saw this with gold, where central bank buying hit record levels last year. But silver is starting to catch that same bid. The National Bank of Poland just announced they're adding silver to their reserves for the first time in 40 years. The Reserve Bank of India has been quietly accumulating silver. These aren't small players. These are major central banks signaling that silver has a role to play in the monetary system going forward. You know what's fascinating? If you go back and look at the gold-to-silver ratio historically, silver has always been undervalued relative to gold when that ratio gets above 80-1. Right now, we're sitting at about 88-1. That means it takes 88 ounces of silver to buy 1 ounce of gold. The historical average over the last century is closer to 60-1. During periods of monetary stress, that ratio has compressed dramatically. In 2011, it got down to 32-1. In 1980, it briefly touched 17-1. If we just revert to the historical mean of 60-1 and gold stays where it is, silver would need to rise about 47% from current levels. But if we get any kind of monetary crisis, any kind of real inflation scare, any kind of loss of confidence in fiat currencies, that ratio could compress much faster and much further. A move to 40-1 would more than double the silver price from here. And that's not some wild-eyed prediction. That's just mean reversion to ratios we've seen multiple times in living memory. Let me paint you a picture of what I think is coming, based on the data we're seeing. We're in the early stages of a supply crisis in physical silver. The warning signs are everywhere if you know where to look. Premiums on physical silver coins and bars have been elevated for months. Delivery delays are becoming common. Refineries are running at capacity and still can't keep up with demand. Major mints around the world are rationing sales to dealers. At some point, and I believe this point is coming soon, we're going to see a disconnect between the paper price and the physical price. It's already starting to happen in small ways. You can see it in the premiums. But when this really breaks, when industrial users start competing directly with investment demand for physical metal, when the COMEX has a delivery default, or comes close to one, the price discovery mechanism is going to shift from the paper market to the physical market. And when that happens, the price is going to move in ways that shock people. I want you to think about what happened with nickel on the London Metal Exchange in March 2022. Nickel was trading around $25,000 a ton. Then, in the span of about 48 hours, it went to $100,000 a ton. A 4 times move in 2 days. Why? because there was a massive short squeeze, and the people who were short couldn't deliver the physical metal. The LME actually had to halt trading and cancel trades because the price move was so extreme. Now, I'm not saying silver is going to quadruple in 48 hours, but I am saying that when you have a market where paper claims vastly exceed physical supply, and that imbalance gets exposed, price moves can be violent and sudden. The smart money is already positioning for this. If you look at the commitment of traders reports from the CFTC, you can see that commercial hedgers, the people who actually produce and use silver, have been reducing their short positions dramatically. They're the ones who usually sell futures to hedge their production or inventory. The fact that they're covering those shorts tells you they're worried about higher prices. Meanwhile, large speculators, the hedge funds and trading firms, have been building long positions. They smell blood in the water. Here's something else that's not getting enough attention. The cost of producing silver has been rising steadily. Most silver, about 70% of it, comes as a byproduct of mining other metals like copper, lead, and zinc. When those base metal prices are low, the economics of mining get challenging, and silver production suffers. We've seen this play out over the last few years. Major mining companies have been underinvesting in new projects. The pipeline of new silver mines coming online over the next 5 years is the thinnest it's been in decades. That means even if prices rise significantly, it's going to take years for supply to respond. And let me tell you something about mining economics that most people don't understand. When a mining company looks at developing a new project, they need to see sustained high prices before they'll commit the capital. We're talking about billion-dollar investments that take 7 to 10 years from discovery to production. So even if silver goes to $50 or $60 an ounce tomorrow, we're not going to see a flood of new supply hit the market for years. The supply deficit is structural, and it's going to persist. Now, I want to take a quick moment here because this is important. If you're sitting on $100,000 or more in retirement accounts, you should know that you can actually hold physical precious metals in a tax-advantaged retirement account through what's called a gold IRA. I put together a free guide that explains exactly how this works, how to do it without triggering taxes or penalties, and what you need to know. It's in the description below. Worth checking out if you're thinking about protecting some of your retirement savings with physical metals. All right, back to where this market is headed. The geopolitical situation is adding fuel to this fire in ways that are hard to overstate. We're watching the global monetary system fracture in real time. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternatives to the dollar-based system. They're talking about a commodity-backed currency. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. And every single one of these initiatives increases the importance of physical commodities, especially precious metals, as stores of value and potential backing for currencies. Russia and China have been accumulating gold for years. Everyone knows that. But what's less well known is that they've also been accumulating silver. China is the world's largest producer of silver, and they've been keeping more and more of their production domestic rather than exporting it. Russia has been adding silver to their state reserves. These are not random decisions. These are strategic moves by countries that see the writing on the wall for the current monetary system. Think about what happened in 2011. Silver went from about $18 an ounce in August 2010 to nearly $50 an ounce by April 2011. That's a 177% move in 8 months. What drove that? It was a combination of factors. You had QE2, quantitative easing by the Federal Reserve, which created inflation fears. You had the European debt crisis, which created safe haven demand. And you had a massive short squeeze in the paper market as investors rushed to take physical delivery. The conditions we're seeing today are remarkably similar, except the imbalances are larger. The supply deficit is worse, and the geopolitical tensions are higher. Here's what I find most compelling about silver right now. The downside is limited, but the upside is enormous. If I'm wrong, if the supply deficit doesn't materialize, if industrial demand softens, if investment demand doesn't pick up, what's the worst case? Silver might drift down to $22 or $23 an ounce. That's maybe 10% downside from current levels. But if I'm right, if even half of what I'm describing plays out, we're looking at $40, $50, potentially $60 or higher over the next 12 to 24 months. That's a risk-reward ratio that's incredibly attractive. And here's the thing about silver that makes it accessible to regular investors. Unlike gold, where you need thousands of dollars to buy a meaningful amount, you can get started with silver for a few $100s. A tube of silver eagles, 20 coins, costs less than $700 at current prices. That's a position size that makes sense for a lot of people who want exposure to precious metals, but don't have tens of thousands to deploy. But here's what you need to understand about timing. Markets like this don't give you a lot of warning before they move. The signs are there if you're paying attention, but by the time it's obvious to everyone, the easy money has already been made. When silver was at $18 in 2010, people said it was too expensive. When it hit $25, they said they'd wait for a pullback. When it hit $35, they said they'd missed it. And then it went to $50, and those same people were chasing it at the top. Right now, we're in that early phase, where the fundamentals are screaming that something big is coming, but the price action hasn't confirmed it yet. This is when the smart money positions. This is when you want to be accumulating physical metal, not when it's already doubled and everyone is talking about it. I want to tell you about a conversation I had with a bullion dealer in Texas last month. This guy has been in the business for 30 years. He's seen multiple bull markets in precious metals, and he told me something that stuck with me. He said, "In all my years doing this, I've never seen the disconnect between paper price and physical availability this extreme. We're selling everything we can get our hands on. Premiums are high and rising. Delivery times are stretching out, and the price is barely moving. That tells me the paper market is suppressing the price, but it can't hold forever. When it breaks, it's going to be spectacular." That's coming from someone who has no incentive to hype the market. He makes money whether prices go up or down, as long as people are buying and selling. But he's seeing something in the physical market that's unprecedented, and he's positioning his own portfolio accordingly. The institutional money is starting to wake up to this opportunity too. We've seen several new silver ETFs launch in the last year. Sprott Physical Silver Trust has been seeing consistent inflows. Even some of the big hedge funds that traditionally focus on equities are adding precious metals exposure. When the institutional money really starts flowing into this market, and we're talking about funds that manage billions of dollars, the available physical supply is going to get absorbed incredibly quickly. Here's a thought experiment for you. Let's say just 1% of the money currently sitting in global equity markets decided to move into physical silver. Global equity markets are worth about $100 trillion. 1% of that is $1 trillion. The entire above-ground supply of silver, all the silver that's ever been mined and still exists in some form, is worth maybe $1.4 trillion at current prices. And most of that is in jewelry, silverware, industrial applications, not available for investment. The amount of silver actually available for investment is probably closer to $200 billion worth. So if just 1% of equity money wanted to move into silver, it would be trying to buy 5 times more silver than exists in investable form. What do you think happens to the price in that scenario? Now, I'm not saying that's going to happen tomorrow, but I am saying that the potential for a massive repricing of silver is very real because the market is so small relative to global financial assets. It wouldn't take much money flowing in to move the price dramatically. The other thing to consider is the inflation picture. Official inflation numbers have been coming down, but anyone who actually buys groceries, pays rent, or fills up their gas tank knows that prices are still significantly higher than they were a few years ago. And with governments around the world running massive deficits, with central banks still holding enormous balance sheets, with geopolitical tensions driving up energy costs, the risk of another inflation spike is very real. And when people get scared about inflation, when they start to lose confidence in the purchasing power of their currency, they buy hard assets. They buy real estate, they buy commodities, and they buy precious metals. Silver has historically been one of the best performing assets during inflationary periods. In the 1970s, when inflation was running hot, silver went from $1.50 an ounce to $50 an ounce. That's a 33 times return. Even accounting for inflation, that was an enormous real return. We're not in the 1970s anymore, but the dynamics are similar. We have massive government debt. We have central banks that have printed trillions of dollars. We have supply chain disruptions. We have geopolitical tensions. All of these are inflationary pressures that could drive people toward hard assets. And here's something that's underappreciated. Silver is more volatile than gold. When precious metals are in a bull market, silver tends to outperform gold significantly. We saw this in 2010-2011. Gold went from about $1,100 to $1,900, a 73% gain. Silver went from $18 to $50, a 177% gain. Silver gave you more than double the return of gold during that period. If we're entering a new bull market in precious metals, and I believe we are, silver is likely to be the better performer. But volatility cuts both ways. Silver can also fall harder than gold when the market turns. That's why this is not a trade for your entire portfolio. This is a strategic allocation, a position that makes sense as part of a diversified approach to wealth preservation and growth. Most financial advisors will tell you that 5 to 10% of your portfolio in precious metals is reasonable. I'd argue that given the current environment, being at the higher end of that range, or even slightly above it, makes sense. The key is to think of physical silver as insurance that you hope goes up in value. You're not buying it to trade in and out. You're buying it because you understand that the monetary system is fragile, that supply and demand fundamentals are incredibly bullish, and that having a portion of your wealth in a tangible asset that's been money for thousands of years is prudent. If silver goes to $50 or $60, great, you've made a significant return. But even if it just holds its value while everything else is losing purchasing power to inflation, you've still won. I want to leave you with this thought. Every major wealth transfer in history has happened when most people weren't paying attention. The people who bought real estate in 2010 after the housing crash. The people who bought stocks in 2009 after the financial crisis. The people who bought Bitcoin at $200. They all had one thing in common. They saw an opportunity that was obvious in hindsight, but contrarian at the time. They acted when others were fearful or indifferent. Right now, silver is unloved. It's not making headlines. It's not the hot trade that everyone is talking about. And that's exactly why it's interesting. The fundamentals are screaming that this market is setting up for a major move. The supply deficit is real. The industrial demand is growing. The monetary uncertainty is increasing. The paper market is vulnerable. All the pieces are in place. The question is, are you going to wait until it's obvious to everyone, when silver is at $45 and every financial news channel is talking about it? Or are you going to position now, while you can still buy physical metal at reasonable premiums, while the price is still suppressed by the paper market, while you're early to what could be one of the best trades of this decade? I can't tell you what to do with your money, but I can tell you that the opportunity in silver right now is as compelling as anything I've seen in the precious metals market in years. The risk-reward is exceptional, the fundamentals are undeniable, and the window to position at these prices is not going to stay open forever. When this market moves, it's going to move fast, and the people who waited are going to be the ones with regrets.